Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
So today we have Ryan Sudeck with us, and Ryan comes out of New Jersey, but ended up at Stanford. So in a rowing scholarship, I believe. Well, maybe not scholarship, but you were a rower for Stanford. So that is a fantastic athletic endeavor for sure. So great to have you, Ryan. I just kind of give me a few more details of how that all happened and how you got into this wild business of converting hotels to workforce housing.
Thanks for having me, Bruce. I'll try to keep it brief, but as you mentioned, I grew up in Medford, New Jersey, a small town, and had the chance to go out to school in California at Stanford, which is where I met my wife. Ended up jumping into professional career focused on mergers and acquisitions at a few different companies, including places like Amazon and Samsung and Redfin. Got to work on some really exciting acquisitions and transactions, like when Amazon bought Whole Foods. While I was at Redfin, we bought a lender, we bought a multifamily marketing company, and Redfin was really just an intersection of my passions for real estate and technology, and spent a number of years there. And on the weekends, I was investing in real estate myself. So started with buying a sixplex, did a lot of the work myself, ended up renovating that. Doing cash out refi, bought an eightplex, then sold both of those, bought a 16 unit and a 30 unit, just snowballing the investment opportunities together. And in about 2020, Sage Investment Group got started, which is the company that I'm now privileged to be CEO of. And we started by bringing together a number of different individual properties into a fund through an UPREIT. And so I contributed my properties in and then just became a passive investor. Got a little too busy with the corporate career. Didn't have the time to spend doing it myself. So turned into a passive investor until about 2.5 years ago, when I was privileged enough to be able to join Sage as CEO.
Wow, that is quite a story. And so you kind of started out as a traditional investor, kind of moving into apartments and so forth. At what point did you start to get into buying hotels?
Yeah. So we did our first project in 2019. That was a hotel conversion project. My business partner, Ross, found this property. It's 175 units in Tucson, Arizona. Half of it had already been converted from a hotel to apartments. And then the other half was still operating as a hotel. It was right down the street from the University of Arizona. And so the business plan was, let's convert it to student housing, right? Need more student housing. Students will surely live in 250, 300 square feet. And so set off on that business plan in 2019, finished the project in the summer of 2020. Well, what was happening then? We had a global pandemic and students weren't on campus. And so we had to pivot the marketing strategy. And it was really the light bulb moment that inspired us to go after this opportunity, because the property leased up very, very quickly when we just started renting out to, normal folks, non-students. And since then, obviously a lot of capital flowed in with investment dollars in 2020 and 21 and 22. Interest rates went up, and we'd been doing value add multifamily by and large, and those opportunities kind of went away. But the underlying fundamentals of buying usually a distressed hotel and converting it into multifamily were super strong, just because you can take something that trades at a high cap rate, convert it to a low cap rate. But more than that, you're solving an unmet need in the market. Most developers are building Class A luxury, trying to get the most rent possible for their units, whereas we're naturally affordable. On average, it costs us about $100,000 per unit to create these studio units, and they're $300 to $500 less per month than those luxury Class A properties that might just be a mile away.
Wow. So interestingly enough, so now you kind of accidentally got into that market. You were going into student housing, but now you've kind of full blown into converting hotels into workforce housing. How do you decide whether a hotel is going to convert?
Yeah, good question. So we're looking we want it to be well located. So we want it to be in a market that's growing from a population perspective, from a wage growth perspective, from an employment perspective, so that we have a base of tenants that are going to be there. We want it to be located really well within that city. A lot of hotels are. They're in the commercial districts. They're going to be walking distance to the locations where our tenants are working, which is fantastic. It might be cutting down on a 45 minute or hour long commute that they otherwise would have for something comparative from a price perspective. We look for about 100 to 200 units per property. And hotels are really well set up to be converted, unlike offices, because they're already portioned off into rooms. They already have bathrooms. There's a utility wall that we can tap into to add a kitchen, and we fully renovate these top to bottom. They feel like a new property by and large when we're done with them. Interiors of the units, the exteriors of the units, adding the kitchens, but then also taking the amenity space that the hotel has, whether that's conference space or a gym, and refreshing it and repurposing it into something that apartment tenants would like to use.
Wow. So when this all happens, it sounds very complicated. How long does it take you to convert one of these properties?
On average, about 12 months.
Yeah. Okay. So for you come in now, I assume, given the pandemic, that the hotel world is in kind of a depressed state of affairs.
100%. Yeah.
So that's an advantage for you. If you find the right property in the right location with the right market, you can convert these and pull off basically workforce housing in these locations.
Yeah. I mean, you mentioned the pandemic. That's certainly been a huge stress on the hotel market. We're not traveling like we used to. We're not traveling for business like we used to. You and I are talking over Zoom. That wasn't even a thing, what, 7 years, 6, 7 years ago.
Right.
And so, a lot of those travelers have gone away, but also it's not too difficult to build a new hotel and attract all the guests in that area. And
Oh,
so the competitive threat is also there for hotels, because if you're a traveler and there's something comparable or maybe a little bit more in price, but it's a 4 star instead of a 2 star, you're probably going to stay at the 4 star property, and the 2 star property is going to suffer. There's also a lot of multi-generational owners in hotels, a lot of Indian
right.
Americans who immigrated to the country a long time ago, educated their kids, but now want to move on from the hotel business. And then there's also folks that just got a bit over their skis with debt, where we've had lenders reach out to us in trying to help solve some problems there.
So how much do you actually finance of these projects?
On average, 65 to 70% of the total cost.
And rates are obviously up a little bit, coming down, but it doesn't sound like that's affected you too much.
No, I mean, I'd say the fall of 2023 was the low point. That was probably the hardest time to get debt financing for just about anyone in real estate. If in 2023, there's the regional banks were having liquidity crises, but now given our track record, we started our 25th hotel conversion project just recently. Given our track record and where we are in the market, and the fact that a lot of banks and credit unions like to be able to invest in their local communities. We are seeing some really good bridge to mini perm debt products, and otherwise we'll work with debt funds to finance the projects.
So how far and wide are you? All over the
We're
U.S.?
Yeah, so I'm located just outside of Seattle. We have a number of our properties are here in Washington State. It's a great market to invest in. We're landlocked. We've got water on one side, mountains on the other, and a lot of job growth, a lot of population growth. And then we're as far away from Seattle as North Carolina and South Carolina right now.
Oh
So
yeah.
we're in 6 states, planning to be in, by this time next year, I think we'll be in 8 states. We're trying to go a little bit deeper in some of the markets that we're in, like Charlotte and Columbia, and Dallas and Houston, but also adding Florida and Colorado.
Oh, Colorado, interesting. The Denver
Yeah.
market, I assume.
Yeah, the Denver. We've also looked at Fort Collins a little bit. We've run into
Oh,
some snags in the diligence process, mainly with the local jurisdiction out there. But yeah, primarily Denver for the Colorado market.
well, that's an interesting question. Why would you run into a snag? You've already got a hotel, you've already got the parking. Where did the snags come in?
I think if you and I wrote the code book, we might write a code book for hotel conversions, but one doesn't exist, and so
Uh,
many jurisdictions treat us as new construction. And even though it's an existing property, because we're taking it from a commercial use and moving it to residential use, it's hard. It's hard for jurisdiction. Ultimately, they're trying to do the right thing and they're trying to do their
right.
jobs. Certainly, politically, what we're doing is very well welcomed. But we have to come in and educate them and be very collaborative about what requirements we're going to be held to so that we can get the right scope of work for the project. We're lucky that we now have a head of planning, Jeff, who's fantastic, an architect by trade, and a head of community relations, Whitney, who are kind of our advanced team. So they'll talk to the mayor, the city council, but then also the planning, permitting department to say, all right, here's what we're trying to do. Here's how we've seen other cities apply the code book to us. Do you agree? So I think it's really just flipped the conversation on its head in a way that the first couple projects we did, we were takers of. We were saying, hey, we're going to do this. What do we
Yeah.
need to do?
Yeah.
Whereas now we're just able to be a bit more forward and drive that conversation.
Well, after 25 properties, you kind of know what you're doing and what's going to happen. And
Mhm.
typically, I mean, I'm originally from Boulder, Colorado, so I can sort of relate to what's happening in Fort Collins. Although I'm curious, in Fort Collins, I would have thought that was more of a student housing play than a workforce housing play.
Yeah, yeah, potentially. I think in that market specifically, we just the city wanted to charge impact fees that would be, comparable to what, a 6,000 square foot house would be for a, 300 square foot studio unit. And so it just made the financials of the project untenable. So, um,
Oh, oh, I see. So they were applying oh wow, yeah, okay, impact fees, yeah. So all of a sudden the numbers don't work. So I
no.
assume you go into escrow or you go into contract, and then you go through your due diligence. How long does that typically take?
Typically, we're under contract for about 6 months with sellers.
Oh
We set
wow.
their expectation that, we need to move through the permitting process. We need to understand, make sure that we can get a building permit, which is usually contingent on having a change of use of the property before we acquire it, because we don't want to take on that entitlement risk. So on average, 6, sometimes longer months to go through the diligence process.
Well, and I would assume, obviously, since you've gone through this, that most hotel sellers are willing to do that because they probably don't have a lot of other buyers out there.
Yeah, their options really are to sell to another hotelier who's going to keep the property the same. They're probably not going to get a good dollar for that. Sell to another hotelier who's willing to put in the couple $1 million of capex to do a PIP on the property and maybe elevate it a little bit to attract better guests. That's probably not going to be, as attractive of an offer. Or sell to us where, we are going to take more time, but if so long as nothing egregious comes up, we're going to do what we say we're going to do. I think we've got a good reputation within the community for, kind of closing on the properties that we, kind of check all the boxes on and doing it in a timely manner.
Yeah, so it sounds like that they're fairly optimistic or fairly willing to go through that process to just get a sale done. And in the meantime, they can go ahead and lease out or sell, sell their hotel rooms during the process. So in a way, they're not really losing money, I suspect.
No, no. I mean, we asked that they shut, by and large, we asked for them to shut down operations before we close or like on the day we close, but they can continue operating the hotel. I think a lot of times, we know what we're willing to pay because we have the data on how much it costs us to do these renovations, and so we're pretty boring. We'll wait around. Sometimes it'll take 2, 3 years for a seller to realize that we're the best buyer, and usually our price hasn't gone up; it's only gone down. It's just I think that's probably similar with other aspects of real, all aspects of real estate. It's not specific to these type of sellers or this strategy.
So how are you finding these properties? Is it coming in through brokers or are you going and finding properties? Which way is this working? A little of both?
Both. Yeah, a little bit of both. My partner Ross leads our acquisition efforts, and he's built an off-market pipeline that started really in 2014 and has been focused on hotel conversions for the last 4 years or so. So a lot of direct seller engagement, going out to hotel conferences more and more now. But brokers, wholesalers, and then the last category is lenders. Of the last, let's see, 7 or 8 properties that we bought, about half of them have been working with a lender when they've had a borrower that's either in default or early foreclosure proceedings, and where we've been able to step in, sometimes for 50 cents on the dollar or less than what the properties previously transacted for.
So how do you find those? Do the lender come to you or do you find the lenders?
A little bit of both. One situation was a lender who we've worked with for many years found us. We happened to be at the same conference, and they bumped into us and said, "We have this problem. Can you help us solve it?" Another one was a property that's on the same street as 2 others that we own that we've been watching for a while, and saw it kind of progress, and we just kind of maintained that relationship, reached out to the lender.
You kind of knew it was going to go into default and you kind of,
Yeah, certainly we it was a hotel that hadn't been worked on. It had been acquired with the purpose of converting it, and it had
oh,
been sitting vacant for quite some time. So
wow.
we had been watching it keenly.
So it doesn't sound like you're coming to the Bay Area anytime soon.
I hope we can.
Oh,
I've
interesting.
we've definitely toured properties in the Bay Area. I think our model would work quite well. Obviously I've seen
Yeah.
what San Francisco rents have been doing recently. Obviously affordability is getting even worse there. It was already bad. So would love to make it work.
Well, I'm surprised have you, well, we can talk about this a little later, but anyway, it is a great market and there are some properties out there that I think would work for you. So anyway,
Mhm.
that'll be interesting to see what happens. So what's your kind of prediction or crystal ball saying down the road here?
As far as what? As far as the
Well,
market or
it sounds like
Sage?
it's very optimistic. How long do you think the hotel market is going to stay in the doldrums before they kind of pop back? Any clue?
I don't see I don't see it
You
coming
don't see it
back.
happening.
I mean, I think our strategy has at least 5 years
Yeah.
to it. We estimate that there's about 70,000 properties that meet our criteria and markets that we like. And I think there's this, like we talked about earlier, there's kind of this natural, dare I say, death spiral that happens with hotels where as it gets older, as you might have competitive threats, you kind of drop a flag. For those who don't know, right? If you're a Marriott flagged hotel, Marriott has their requirements. You have to
Right.
have your carpet a certain way, certain fixtures and finishes, and every so often you need to update it. Well, if your revenue's been down, your income's down, you can't justify making those improvements. So you might drop a tier, right? You might go from a Marriott to a lower tier, and that might happen a couple times. And I think that's a natural evolution in hotels that exists. That's going to keep a pipeline there. But I certainly think the acute challenges of the post-COVID era are going to be here for a while.
So that is an interesting point, and one of our local fellow Rotarians owns a hotel down in the Mountain View area, at any rate, and he was explaining to me that yes, there's the flag, there's the people that are the flag, and then there's the property managers, and then there's the owners, and then there may be another level there. There's several levels to how this all goes together.
That's right. Yeah. Yeah, so you as an owner might hire a hospitality management group, a property management group, and then you have your franchise agreement with Marriott or Hilton or Hyatt or whomever that helps you with marketing and things like that.
Yeah, so they're just sort of a layer on top. And
Hmm.
it sounds like once you buy these properties, it's pretty easy to disassemble those contracts so that they don't continue on.
Not necessarily easy. I mean, we need to work through the process, depending on what the terms are of that agreement. But that's certainly something that we've become, accustomed to navigating.
Yeah, yeah, experts, if you will.
Yeah.
Yeah, well, do you have a legal team in-house or how do you handle that?
We do have a general counsel in-house. We brought Steve on was that February of this year after working with him as outside counsel for a while. He's been fantastic.
Oh, that's great. That's great. Well, this is certainly a growing market. Kind of one last question I'm curious about. How many people rent a workforce apartment, but they have a house somewhere else? I suspect that
Mm.
happens.
Yeah, I'm not aware of any of our tenants that fit
Oh,
that category. There might be some that do. By and
yeah.
large, we're serving three core demographics. One is the young professionals, the folks that were maybe living with mom and dad or living with roommates that want to go out on their own. The second is that just kind of working class, middle age, single person or maybe a couple, usually with a pet.
Oh,
Think of military professionals, nurses, teachers, waiters and waitresses, dock workers. And then the third demographic that we serve is, kind of 55 plus, fixed income, aging in place, usually a couple that don't need a whole lot of space, but are looking to, manage their budget.
do you take Section 8 folks?
We don't seek it out, but certainly, just operating by fair housing laws, we don't.
You can't discriminate. Yeah.
Exactly, of course.
Yeah. So that's interesting. So of those three categories, uh, I assume the young group is the largest group. Maybe
I
not.
think maybe, yeah, I think it's actually probably a pretty close distribution, pretty equal distribution. Again, it depends on where the property is located.
Yeah.
We have some of our properties are near universities, and we do get some students that come in there, usually not more than 20% though. Um, so yeah, it just kind of depends on the project.
Well, yeah. Well, that's good. Very intriguing. Well, I think this is going to be obviously a booming market, and you're kind of counting on that. Are there? I don't know of any other competitors out there. How many other competitors do this?
Not many. There are a few that have done, a handful of hotel conversion projects that we're aware of and, collaborate with and have great relationships with. But I think we're kind of largely emerging, kind of emerging as kind of the largest that's doing this strategy. It's tough, we kind of play in this interesting pocket in the market where these are heavy development projects that have entitlement risks that have to be navigated that have our typically our cost of renovation might be equal to what we acquire a unit for. So
Yeah.
these are heavy development projects that need to be navigated. And we have a team of 30 at Sage to execute on these projects now. So it kind of it's kind of this interesting niche where we're kind of big enough and complex enough that a lot of mom and pop shops aren't doing it, but maybe not quite institutional scale because our projects are typically 10 to 20 million dollars in total development costs.
And it sounds like the big boys are kind of not interested in this particular property type, so to speak, and making conversions.
I think a lot of them are very interested in, like I've talked to many
Oh,
who are interested. Um, some of them have invested in office conversions in Manhattan, or hotel conversions in, some
oh,
of the more luxury markets. But a lot of the institutional investors, the big boys, as you called them, they want to deploy a lot of capital at once. And our average equity check per
oh.
property is $4 to $8 million. And they're trying to put out, 25, 50, $100 million to work at a time, because that's how they get compensated. Um, so again, I think that's why we kind of fall in this interesting little niche here.
Well, and that brings me to the point that talk about your evergreen fund a little bit.
Mm. Yeah, so we raise our capital through our Evergreen Fund. We've raised just under $150 million so far. Started with friends and family. My partners and I are the largest LPs in the fund, so we're kind of incentivized to do well here. Um, but our investors, we ask them to join for a 5-year commitment, and then they can redeem. They have redemption rights thereafter, and for that they benefit from potential equity appreciation and value increase, but also distributions of cash along the way. So it's a unique structure, I think, for a lot of folks who might be used to a syndication model or maybe a closed-end fund. We like it because it's got diversification, it's got a lot of tax advantages too, and we try to strike that balance of strong equity returns, but also that opportunity for cash flow along the way.
So are you thinking you might eventually go to a REIT? What's your thoughts in that regard?
I don't know about that. We don't spend too much time thinking about, kind of,
You're too
the
busy
end
with the
game
other
or
stuff.
what that. Yeah, I think we've got a great model. So continue to invite more investors to join us. But within that, we also try to do 1031 exchanges within the fund. These when we increase the value of these projects, we have the opportunity to do cash out refis and buy additional projects. And so the goal is to be very efficient with our capital and just chasing, strong risk adjusted returns.
Yeah. No, this sounds fantastic. So, for the audience out there that are investors or hotel owners, where can they get a hold of you?
Yeah, you can find me on LinkedIn under my name. You can certainly reach out to us via our website, which is sageinvestment.com. I got a form on there that you can fill out. But yeah, would welcome to connect with anyone that's got some thoughts or questions. Would love to learn more.
No, that's fantastic. Well, this is very interesting. I think I want to come back and talk to you again in 3 to 6 months and see how things are going, see if the market's changed at all. But it sounds like it's kind of in a very good position for where you are.
Yeah. Yeah, we feel pretty confident. We've got 13 projects that are delivering this year after delivering 3 last year. So it's been a
Oh,
very
wow.
exciting year for us.
Oh, my
So
gosh.
lots of lease ups happening, which is a very exciting time. And we're not really relying on any market tailwinds, right? We're pricing to be naturally affordable, and I think our recent success has shown that we've been relatively conservative on our assumptions, and there's just this insatiable demand for naturally affordable housing.
Absolutely. So what's the just kind of last question here? What's the average price of a unit to lease out?
It varies dramatically based on the market.
Uh,
I'd say a good rule of thumb, maybe $1,200 a month
oh,
in
wow.
rent, but in a market like Columbia, South Carolina, closer to 900 to 1,000 in a market and that's base rent, uh, plus utilities and tech fee. Uh, and then for a market like Bellevue, Washington, more of a luxury market, 1,600 base rent. And that's for, 200 and some
Keep
odd
coming up with
square
more
feet.
questions. So
Yeah.
each unit typically has a hotel size room with a bed in it, and how many of them have little kitchenettes or whatever?
Yeah, about 300 square feet is the typical size.
Yeah.
Most of the properties that we acquire don't have kitchens in them already, and we'll put them in.
Uh,
It's usually cheaper for us to do that than buy a property that already has them in. Those properties usually command a little too much of a premium. I think extended stay hotels are doing quite a bit better than those, that are more
oh,
limited
I see.
amenities within the unit.
Oh, interesting. Yeah. Huh. So they're sort of competing with you in that they're a little bit longer term stay usually.
Yeah, I think you get a lot of journeyman workers and others that'll do weekly stays at extended stay hotels.
Yeah. Oh, so you do very short term if you need to.
We do not. Sorry, that's speaking
Oh,
about those
oh,
type
okay,
of
okay.
properties. For us, we're 12-month leases
Yeah,
typically.
okay. All right, that makes more sense. Yeah. You don't want to basically get back into the hotel business.
No. The goal is to meet the housing need for folks who want to be there for a while. And we find that tenants tend to stick around. The first hotel conversion project we did, I think the average tenancy is approaching almost 2 years, which is
Wow.
about, I think, 50% higher than the national average. I think the national average is about 15 to 17 months, and I think we're at a little over 22 months there.
Wow. That is impressive. I mean, I suppose you after a year or two you start to get a little bit small in terms of size and you want to get bigger or whatever, but it kind of depends on the person.
Mhm. Certainly.
All right, well, let's end it for now, but I certainly think we should talk again very soon.
I'd
I'm
welcome it. That'd be
intrigued by
awesome.
this whole thing.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.